Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. And also, make sure you check out the VIP Algos link below in the description.
Right. It is an amazing tool.
Yeah, we'll talk more about it at the end, but the link is right down there. So, let's just jump right into this. Imagine stepping onto a massive plot of dirt. Nothing is built.
Just an empty lot.
Exactly, just dust.
Right.
There's no foundation poured, there are 0 tenants, and absolutely no rent checks are coming in.
Right.
Now imagine the broader market looks at this empty lot and just confidently slaps a $7 billion valuation on it.
Which is, that's just wild to think about.
It is wild. In almost any other sector, a publicly traded company with literally 0 commercial revenue gets laughed right out of the room.
Oh, absolutely. They'd be dismissed instantly.
But when that company holds the potential keys to powering the next era of artificial intelligence, well, the market suddenly starts playing by an entirely different set of rules.
It really does. It forces a complete reevaluation of what a business is actually worth,
Yeah.
You are looking at a scenario where investors, they aren't buying a current stable revenue stream. They are basically buying a place in line.
A very expensive place in life.
Exactly. They're valuing a technology that could solve the single most urgent energy bottleneck of the 21st century.
And that is the exact paradox of Oklo. The ticker symbol is OKLO.
Right.
They are a clean energy developer sitting right at this chaotic intersection between the AI computing explosion and the global scramble for reliable carbon-free power.
It's a very intense space to be in right now.
For sure. And they recently achieved some monumental regulatory milestones. But if you pull up their stock chart today, they are down nearly 80% from their peak.
Yeah, it's a brutal drop.
So today, we're tearing down the financials, the recent market data, and the July 2026 technical analysis. We need to figure out if this zero revenue giant is a visionary wealth-building play or just a spectacular bubble waiting to pop.
Mm-hmm. And to really understand that crash, we first have to understand the initial hype. What exactly justifies a multi-billion-dollar valuation for a company that isn't actually selling anything yet?
Right. It comes down to the technology itself. Oklo isn't building the nuclear plants our grandparents knew.
No, not at all.
We aren't talking about those massive, sprawling concrete cooling towers that take 20 years and $20 billion to construct?
Yeah, the ones that are always notoriously over budget.
Exactly. Oklo is developing small modular reactors, or SMRs. And specifically, they are focusing on fast-fission microreactors.
Which is a huge distinction.
It is. I think the best way for you listening to visualize this is to think of them less as traditional power plants and more like massive, highly advanced batteries.
That's a great analogy, because they can be manufactured in a central factory, right?
Yep, built in a factory, loaded onto a standard flatbed truck, shipped to a specific site, and basically plugged directly into a data center.
And that factory-built modular model is crucial here. It theoretically eliminates those massive cost overruns and construction delays that have just plagued the traditional nuclear industry for decades.
But the financial reality on paper right now, it is undeniably stark.
Oh, yeah.
They have 0 commercial power generation revenue. Their earnings per share sits at a negative 83 cents. They are burning cash to fund development, not generating it.
Right. They are entirely in a cash burn phase.
Let me pause on the financials for a second, because the price-to-book ratio in the data is flashing at roughly 2.6.
That's high for a company with no revenue.
Exactly. For anyone casually tracking this metric, the book value is essentially what the company would be worth if you liquidated all its physical assets today.
The desks, the computers, maybe some testing equipment.
Right. So the PB ratio over 2.5 means investors are paying a massive premium over those physical assets. They are heavily pricing in the invisible stuff.
The intellectual property.
Yes, the IP, the blueprints, and most importantly, the permits.
Because the market is really valuing their momentum. The key metric to watch here isn't cash flow at all. It's regulatory velocity.
Regulatory velocity, I like that term.
Yeah, just look at July 23, 2026. Oklo secured a startup authorization from the U.S. Department of Energy for their Grimes isotope test reactor.
Which is huge.
It is. They went from the initial groundbreaking to full authorization in just over 10 months.
And we have to emphasize this. 10 months in the nuclear world is practically time travel.
It's unheard of.
Historically, the Nuclear Regulatory Commission can take years just to read an application.
Right.
We're talking about bureaucracy where a single environmental review or, a minor zoning dispute can stall a multi-billion-dollar project for a decade.
Oh, easily.
So securing a DOE green light in under a year tells the market they haven't just designed a cool reactor in a lab, they've actually cracked the code on navigating the labyrinth of federal red tape.
And that speed acts as a massive de-risking event. It proves the management team knows how to play the bureaucratic game.
Which might be harder than the physics game, honestly.
Honestly, yeah. In an industry where time literally equals millions of dollars in financing costs, proving you can move fast is the most valuable, intangible asset you can put on a balance sheet.
But, moving fast through a government bureaucracy only matters if you can translate that speed into a defensive wall against your competitors.
Exactly, you need a moat.
Right. And the analysis breaks this defense down into a three-pillar moat. Let's look at the first pillar, which is switching costs.
This one is fascinating.
Yeah. So if a major client, say a tech giant, building a billion-dollar data center, if they commit to an Oklo reactor design for their site, they are effectively locked in.
Right. They can't just back out easily.
Not at all. Not because Oklo's tech is magically impossible to replace, but because if you swap them out for a rival reactor halfway through, you have to hit the reset button on that entire regulatory clock.
You'd be throwing away years of site-specific permits.
Exactly. Time is the ultimate switching cost here. In the tech sector, delaying a new AI data center by 3 years means you lose the AI arms race entirely to your competitors.
So once an Oklo design is integrated into a site plan, the regulatory friction of changing course is so exceptionally high that the client is practically married to them.
Which brings us perfectly to the second pillar of their moat, their integration into government consortiums.
Right. This is where the big players come in.
Yeah, Oklo is sitting in a federal program right alongside Microsoft and NVIDIA to accelerate power plants specifically for AI data centers.
Now, on the surface, this feels a bit contradictory, doesn't it?
It really does. I mean, the big tech companies have spent the last decade plastering their websites with solar panels and wind turbines. They want to be seen as 100% green.
So pivoting to nuclear seems like a massive public relations risk for a consumer brand.
But that PR risk was the dominant narrative 5 years ago. What changed is the physical, inescapable reality of AI training models.
Right. Solar and wind are incredible technologies, but they are intermittent by nature.
A cloud cover rolls in, or the wind dies down, and your power output just drops.
Exactly. You can try to bridge the gap with massive lithium-ion battery banks, but the sheer scale of energy required to train a next-generation large language model is staggering.
We're not talking about a few extra servers.
No, we are talking about facilities that require hundreds of megawatts of uninterrupted 247 baseload power.
Because the AI doesn't sleep. It doesn't care if the sun went down in Nevada. It needs a constant, massive IV drip of electricity.
And when you filter all the carbon-free energy sources for the ability to provide that relentless industrial-scale power, nuclear is basically the last option standing.
It's a mathematical certainty at this point. Big tech realized they cannot meet their AI ambitions and maintain their carbon-neutral pledges without embracing nuclear energy.
Right, but having a captive audience of tech giants doesn't mean much if you can't actually build the machines.
Ah, the classic supply chain bottleneck.
Exactly.
Standalone reactor startups usually get crushed right here because they can't source the specialized enriched uranium or, manufacture the highly regulated custom machine components. They just get starved of parts.
Which brings us to the third pillar of Oklo's moat, vertical integration.
Yes. They secured a spot in a DOE-approved nuclear fuel cycle consortium with established companies like Solstice Advanced Materials, Mirion Technologies, and Amentum.
These partners are heavyweights.
They are. They handle everything from sourcing the advanced fuel to building the radiation monitoring equipment and managing the waste cycle.
So Oklo isn't out there trying to reinvent the entire nuclear supply chain by themselves.
No, they've embedded themselves in a pre-approved, highly specialized network.
And securing that domestic supply chain is becoming absolutely critical right now, because the demand for constant power is no longer just driven by tech companies wanting to train faster algorithms.
Right, there's a much bigger picture here.
The macroeconomic landscape in late July 2026 has violently accelerated the timeline.
Okay, let's talk about that macro environment, and I want to be super clear to our listeners here. We are just looking at the market data.
Exactly.
We are not taking any political sides or endorsing any viewpoints here. We are strictly impartially reporting on what is driving the market behavior based on the current context.
Just follow in the data.
Exactly.
Yeah.
So looking strictly at the market dynamics in the July data, investors are reacting to a highly volatile geopolitical board.
Very volatile.
The reports highlight an IRGC strike on an Amazon data center, coupled with escalating armed conflict in the Strait of Hormuz, which, we all know is a massive choke point for global oil and gas.
Right. And there are also reports indicating the Trump administration is drafting a program to fast-track nuclear deployment specifically for AI infrastructure, partnering directly with companies like Oklo and X-Energy.
So regardless of the underlying politics involved, the financial markets are aggressively pricing these events as a massive energy security premium.
And that premium fundamentally changes the valuation model.
Mm-hmm.
Well, for years, powering data centers was treated as a standard corporate operational expense. You just paid the local utility whatever the going rate was.
Right, it's just a line item on a budget.
Exactly. But when digital infrastructure becomes a physical target and overseas energy routes are threatened by war, reliable domestic power becomes a matter of national security.
Because a government can't allow the backbone of its future economy, its AI infrastructure, to rely on fragile international energy markets or, vulnerable grids.
Yeah.
It essentially forces a domestic mandate.
And that elevates Oklo's technology from a nice-to-have green alternative to a vital strategic asset.
Wow, yeah.
When national security interests align with the world's most capitalized tech companies, bureaucratic hurdles tend to disappear very quickly.
So if we recap, we have a deep three-pillar moat. We have tech giants desperate for 247 power. We have a geopolitical powder keg forcing governments to fast-track domestic energy security.
The setup sounds flawless.
It sounds perfect. But let's look at the glaring reality check, the stock chart.
Yeah, this is where it gets tough.
In October 2025, Oklo is trading at nearly $194 a share. As of this July 2026 analysis, it is hovering around $40.
Ouch.
That is an almost 80% destruction of value. The market didn't just casually correct, it absolutely panicked.
It's a brutal chart to look at, there's no denying that.
Yeah.
But you have to separate the fundamental underlying business progress from the speculative frenzy of the stock itself.
Okay, unpack that for us.
At $194, the market was pricing Oklo as if they already had 20 commercial reactors plugged into the grid generating cash today.
Which they obviously don't.
Exactly. It was priced for absolute perfection in an industry that is literally famous for delays.
Right.
So the drop to $40, while painful, brings it into a deep value zone, testing a critical support level around $39.53.
And I'm looking at the technicals and the trading volume here, and it's telling a really interesting story.
What do you see?
Even though the stock had a violent 8.5% drop on the day of this specific report, the 5-day return is actually up 7%.
Okay, so it's fighting back.
Yeah, and more importantly, the trading volume is shrinking dramatically. Usually when a stock crashes to a major low and the volume dries up, it means the panic has finally run its course.
Right. Everyone who was terrified and wanted to sell has already sold.
Exactly. It's an exhaustion of selling pressure.
And technical analysts would look at that setup, the exhaustion combined with the slight positive weekly return, and identify a potential higher low formation.
Meaning the stock might finally be finding a solid floor.
Yes, and we are seeing institutional players recognizing this stabilization too. Barclays maintained an overweight rating on the stock, though they did lower their price target to $76.
Let's just put that in perspective for you listening. A $76 target on a $40 stock still implies an 89% upside.
That's a massive implied upside.
It is, and on the broader institutional side, Cathie Wood's ARK Invest has been steadily accumulating nuclear stocks across the board.
Which signals a strong institutional appetite for the SMR sector at these depressed valuations.
It definitely does. But there is one major red flag in the sentiment and the SEC filings that we absolutely cannot ignore.
The insider selling.
Yeah. Over a recent 90-day period, insiders sold a net of over 1.29 million shares. If the tech is so revolutionary and the stock is sitting at a fundamental floor like we just talked about, why are the people inside the building dumping their shares?
I get it. When you see over 1 million shares dumped by executives and early investors, the immediate instinct is to assume the ship is sinking.
It's hard not to feel that way.
Right. However, we have to look at the mechanical life cycle of a newly public development stage company.
You mean the lockup expiration?
Exactly. Founders and early engineers are almost entirely compensated in stock. They go years without a massive cash salary, just grinding away on the design.
Yeah.
When the company finally goes public, they are legally barred from selling their shares for a set period, usually 6 months to a year.
Right.
Once that lockup officially expires, you almost always see a massive wave of selling. These people want to finally buy a house, diversify their portfolio, or, pay their massive tax
That
bills.
doesn't automatically mean they think the reactor design is flawed.
Exactly. It just means human beings need liquidity. And realistically, that mechanical insider selling wave contributed significantly to the 80% drawdown.
The open market suddenly had to absorb millions of newly available shares all at once.
Right. But that flush out is largely complete now. The speculative froth from 2025 has evaporated, leaving a valuation grounded in their actual regulatory progress.
Granted or not, an 80% drop means the risks are very real. The data gives this a bullish score of 7 out of 10.
Which is strong, but leaves 3 points of risk.
Exactly. Let's talk about the bear case. What breaks this company? What causes the thesis to fail?
The loudest alarm bell is definitely dilution.
Yeah. Since they have no free cash flow and a negative EPS, they have to fund their operations and their engineers somehow.
If they run out of cash before a commercial reactor is actually built and selling power, they will have to print millions of new shares and sell them to the public just to keep the lights on.
Dilution is the silent killer of development stage portfolios. Think of the company's value as a pizza.
A very expensive pizza.
Right. If you own a slice and the company decides to double the total number of slices to raise cash, your specific slice just got cut in half. Your percentage of ownership plummets, even if the company's core technology hasn't changed at all.
And that financial risk is severely compounded by execution delays. The market cheered when the Groves test reactor got its DOE approval in 10 months. But a test reactor is tiny.
Right. Licensing their commercial-scale reactor, the Aurora, is a completely different beast.
Completely. If the Nuclear Regulatory Commission decides to drag its feet on the Aurora, or if there's a minor supply chain hiccup with the fuel enrichment, a projected commercial launch could easily slip from 2027 to 2030.
Wow, and that is 3 extra years of burning cash.
Exactly, which forces them to dilute the shareholders even further.
The tension here is immense. You are balancing the urgent, unavoidable demand from the AI sector against the sheer capital intensity and unpredictability of building physical nuclear infrastructure.
But there is a massive wild card at play here that could neutralize the dilution risk entirely.
And what's that?
Non-dilutive government funding.
Oh, let's explain the mechanics of that because it changes the math entirely. Non-dilutive funding means Oklo gets the cash they need to build, but they don't have to issue new shares to get it.
Right. We were talking about direct federal grants, Department of Energy subsidies, or government-backed loans.
Because if the administration officially designates AI power infrastructure as a matter of urgent national security, they aren't going to let Oklo fail just because of a tough venture capital environment.
Exactly. They will simply cut a check to ensure the infrastructure gets built.
Which is why the timeline for this investment is critical. The analysis frames this as a 12 to 24-month hold.
You really have to be patient enough to let these catalysts play out.
Right. Later in 2026, the Groves test reactor is expected to achieve first criticality, which is the industry term for a sustained, controlled nuclear chain reaction.
That proves the physics work outside of a computer simulation.
Furthermore, details on those federal AI and nuclear programs are expected in a matter of weeks.
And if those federal details include massive non-dilutive grants, the dilution risk vanishes overnight.
But if they don't, the upcoming Q2 and Q3 earnings reports will shine a very harsh light on their cash burn.
Right.
So, as a reminder, we never tell you to buy, sell, or hold. We just lay out the upside and the downside.
Exactly.
And the reality is, you aren't looking at this stock for a quick flip next Tuesday. You are taking a calculated position on whether Oklo can survive the financial desert long enough to reach the oasis of commercial deployment.
At $40 a share, the margin of safety is significantly wider than it was last year, but it remains one of the most high-stakes wagers in the energy market.
You're betting on the physical convergence of the digital revolution and the atomic age.
It's a huge bet.
It is. And speaking of that convergence, I want to leave you with a final thought to mull over. Something that goes beyond the immediate stock price or the next earnings report.
Okay, let's hear it.
We've framed this entire discussion around the idea that AI needs massive, uninterrupted nuclear power just to survive and train its next-generation models, right?
Right.
But consider the feedback loop. What happens when AI becomes advanced enough to solve nuclear's biggest historical problems?
You mean the regulatory red tape and the engineering bottlenecks?
Exactly. Imagine training a massive language model on 50 years of dense Nuclear Regulatory Commission rulings, environmental impact studies, and complex legal precedents.
Oh, wow.
A company like Oklo could use that AI to auto-generate flawless, perfectly compliant permit applications in minutes.
Turning a 5-year legal headache into a simple database query.
Exactly. Or think about the physics side of it.
Mm.
Instead of spending a decade physically testing new reactor core materials or coolant flows, advanced neural networks could run millions of simulated stress tests a second.
They could optimize fuel efficiency and safety margins before a single piece of metal is ever cut.
It flips the entire dynamic. AI isn't just the customer consuming the power, it becomes the architect designing the power plant.
We might actually be watching the birth of a self-sustaining cycle where AI literally designs, permits, and optimizes the very energy grid it requires to grow.
And development stage companies holding those early blueprints and those crucial government relationships, well, they might just be the physical bridge between the digital brain and the real world.
It is a fascinating paradigm shift.
It really is, and it's something to keep in mind as you watch this story unfold over the next 12 to 24 months. That is our 7 out of 10 bullish rating analysis for today.
A lot to think about.
Absolutely. Thank you for joining us today. Remember to please consider subscribe, like, and comment underneath. And do not forget to check out that VIP Algos link down in the description below.
It's a game changer. Check it out.
We will catch you on the next one.